Dear students, I welcome you all for the session on budgeting in management accounting. And this is Dr. G. Kavita, Assistant Professor, Department of Commerce, Sri Ramakrishna College of Arts and Science. So today I'm going to cover the topics on budgeting, what is budgetary control, and what are the objectives of budgetary control, what are the advantages of budgetary control, and what are the classifications of budget. So the topic first I'm going to cover is budget. In a simple term, it is a financial plan for the future with an estimation of income and expenses for a set of period of time. So when I just want to explain with you with a small example, we all will be putting budgets for our family. So according to our income, we will be planning our expenses. So for an example, when I'm earning an income of rupees 50,000 per month and I'm having expenses such as rent, loan, school fees, etc. of rupees 40,000, then the balance of rupees 10,000 I have to plan for my investment, that is for my savings. Vice versa, when my expenses are more than my income, then I have to plan where my expenses should be cut off. Hence, it is an estimation of revenue and expenses. The second one is the term budget is derived from the French word baguette, which means a small bag or a little bag which will carry the cash. And it is a plan in the form of quantitative and financial statement of the firm. So it is the work done by the executives and their officials. So the budget will have 6 different steps, such as you just want to know your income, the first step. The second step is to determine your basic expenses, that is the fixed expenses. The third step is to determine your variable expenses. The fourth step is to prioritize your expenses. The fifth step is to follow your spending and review your monthly expenses and income. So the last and foremost step is keep tracking your expenses, what you're doing. So the next topic what I'm going to cover is budgeting. What is budgeting? As of you know, budget is the predetermined statement of management policy. Budgeting is a preparation of comprehensive operating and financial plans for certain intervals of time. This budgeting involves the process of designing, implementing, and operating. And of course, business budgeting is one of the most powerful financial tools available to any small business owner. So the next we are going to see about the budgetary control. It refers to a system of which uses budgets as a means of planning and controlling all the activities related to production and sales of commodities. So it is the exercise of control in the organization with the help of budgets. A budget should provide the information necessary to enable approval, authorization, and policy making bodies to assess the project proposals and take decisions inside a concern. So the various steps which is involved in budgetary control are: the first step is preparation of various budgets. The second step is continuous comparison of actual performance with budgetary performance. The third step is revision of budget, which includes both the measurement and the analysis. So the next topic what we are going to cover is objectives of budgetary control. So these are the various objectives of preparing a budgetary control. It provides plans for achieving the activities. The second, it increases the profitability by eliminating the waste. Third, it fixes the responsibility of various individuals in the enterprise. Fourth, it coordinates the activity of various departments. And fifth, it operates various departments and cost centers economically and efficiently. So the next, we are going to see about the advantages of the budgetary control. So this budgetary control helps in fixing goals for an organization as a whole. So it has the following advantages. As everything is planned and provided in advance, it helps in smooth running of an enterprise. So it secures better coordination among various departments. It helps in reducing the cost of production by eliminating the unwanted or wasteful expenditure. It maximizes the profit, which is done by proper planning. The budgetary control fixes targets, so each and every department is forced to work efficiently to reach the target. In case the performance is below the expectation, the budgetary control helps the management in finding up the responsibility. It ensures the availability of sufficient working capital. As you all know, working capital is required for the day-to-day expenses of a concern, and it diverts its capital expenditure, which means a long-term expenditure. So by promoting cost consciousness among the employees, budgetary control is suitable for establishing incentive system. So the next one is the classification of budgets. Budget is classified into two bases. The first one is classified on the basis of its function, and the second is classified on the basis of its flexibility. So based on the functions, budgets are classified as cash budget, purchase budget, sales budget, overheads budget, production budget, and master budget. So the term master budget is a combination of all other budgets prepared for a specific period. It shows the overall budget plans. It is prepared by the budget officer, and it requires the approval of budgeting committee before it is put into the operation. The second budget, what we are going to see is cash budget. So it is one of the important function budget. It estimates the amount of cash receipt and payment. So it is a summary statement of the firm's expected the cash inflow and outflow over a projected period of time. The overall objectives of preparing the cash budget is to estimate the cash balance and to avoid the accumulation of excessive cash. And here is an example of cash budget where cash receipts and payments are given in monthly term. So to calculate the cash budget, the formula used is cash receipts minus payments. So when we make the receipt minus payment, the total of the closing balance will be the opening balance for the next month. So this is how a cash budget will be calculated. So the third budget, what we are going to see is the purchase budget. So this purchase budget includes the estimates of the required purchases. So while preparing this budget, the purchase officer has to consider the opening and closing stock of the company. The purchase budget is given the details of material purchase to be made in the budgeted period. It provides information to the budgeting officer to provide fund to cash budget according to the delivery schedule in the terms of payments and credit period. So this is an example of purchase budget where the total material usage is given. So we have to add the closing stock in it and deduct the opening stock, and they will be giving the purchase price per kg, and you have to multiply the total material into the purchase price. So now we will get the total material purchases. So the fourth budget, what we are going to see is sales budget. The sales budget is usually a keystone in planning and control of operations of a business. Sales forecast serves as a base for the sales budget. The sales manager is directly responsible for the preparation and executive of sales budget. So, sales budget shows the type of products that will be sold at certain quantity and price. The sales manager can present this budget under several headings such as products, territory, salesman, and month, where the product shows separate sales estimate. The territory shows estimates of sales of different product for each territory. Salesman shows estimate for each salesman or officer in a territory. And month shows for the comparison of each month separately. So the below is the example of sales budget. So here the sales unit has been given, price per unit is also has been given. So to calculate the total gross sales, the sales unit into price per unit and a discount of sales has been given. So to calculate the total net sales, the total gross sales minus discount has been calculated. So the fifth budget is the production budget. It is a forecast of the production for the budget period. It provides an estimate of total volume of production. So it indicates the budgeted quantity of output to be produced during a specific period, and it helps in the best utilization of business resources available for production. So here is an example of production budget where the expected unit of sales is given. We have to add the stock at the end and deduct the stock at the beginning. So the solution what we are going to get is the required units to be produced for a concern. So the next is the overhead budget, which consists of factory overhead, administrative overhead, selling and distribution overhead. So this overhead costs aren't recovered in estimates. So this factory overhead will cover all the direct expenses which is related to the business. Administration overhead is also called as office overhead, which relates all the indirect expenses which is related to the business, and selling and distribution overhead is the expenses which is met to sell a product in a concern. So this is what it is covered in the overhead budgets. So the second main division of classification of budget is on the basis of its flexibility. So on the basis of flexibility, it is again classified into two types, that is fixed budget and the flexible budget. So fixed budget is prepared which is unchanged irrespective of the level of activity actually attained. So this fixed budget will be useful when there is no significant variations between budgeted and actual output. So it is prepared at a single level of activity, and it is suitable for industries where demand for product is reasonable at a degree of accuracy, and it is suitable for fixed expenses. So the next is the flexible budget. So this flexible budget, it is also known as variable budget. So it is designed to change according to the level of activity actually attained, and it is more realistic, useful and practical. So this flexible budget changes with the level of activity attained, and it also portrays the budgeted cost of sales and profit, and it is not prepared for single specific volumes but for different volumes. So here is an example of calculation of fixed and flexible overhead. Here it is calculated for 70%, 80% and 90% capacity level, where variable overhead under that indirect labor. So to produce 80% of capacity level of goods, 24,000 has been expended. For 70%, so 24,000 divided by 80 into 70, if you are calculating, you will be getting 21,000. And for 90%, 24,000 divided by 80 into 90, you will be getting 27,000. So stores including spares, it is also calculated in the same way. And semi-variable expenses, which has both fixed and variable expenses, when they have given as 30% fixed, remaining 70% will be variable, where this 30% is fixed will be same for all the capacity level of goods, and variable 70% may vary for all the capacity level. And repairs and maintenance, where fixed and variable has been given, fixed is 80% and variable is 20%, where fixed 80% remains the same for all the capacity level of goods, and 20% varies for all the capacity level. And fixed overheads, what I have previously said, this fixed overhead will not change, it will be same for all the capacity level of goods. So total overheads will be calculated by putting the total of all 70% capacity level, it is 1,15,900, and 80% capacity level, it is 1,24,000, and 90% capacity level, it is 1,32,100. So this is how the fixed and flexible budget will be calculated. Thank you.